In this video, I want to do a portfolio update, how my portfolio reacted during this earnings season, earnings reports that were pretty intense. Plenty of stocks got demolished, crushed. All the software companies are down, but despite all of this, the market is flat year to date. So what is happening right now? And I want to go through each of my holdings. If you want to spoil the fun, this is the holdings we are going to talk about today. 12 stocks, 12 companies. The majority of them already reported earnings, and I want to talk about them. I have a lot of confidence in this portfolio entering 2026 because I'm seeing some key trends, and I think all the stocks I have in my portfolio will benefit from what is happening in this market, from what is happening in the world. So when it comes to the quality of the businesses on a micro level, I love it. And when it comes to the macro level, I love it. So I think this portfolio is designed to outperform the market. And what is great is this portfolio is public. As always, my portfolio is public. So you can track what I do and you can actually copy my trades, copy my portfolio, because you can just type my name on eToro. Anyone can copy my portfolio. I have more than 300 people copying my trades live to have the same performance. In case this is your first video from this channel, welcome. My name is Christophe Nour. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I have always had a concentrated portfolio. I love it this way, so you can monitor really what is happening. You know really well all your stocks. You are not diversified. You don't diversify your attention span, especially for my newer generation. So it's good to run a concentrated portfolio. And for each earnings season, you have a lot of moves. So to answer the question, how did I react? How did my portfolio react during this earnings season? I'm flat year to date, similar to the S&P 500. So I'm very happy with this software sell-off. Plenty of stocks going down, data providers going down, MSCI, S&P Global, Moody's, all this panic in this market have exactly the same performance as the index for the moment. So very good actually to not be in things that completely crashed. The first stock I have in my portfolio that is holding the performance is Brookfield. Brookfield, as I'm recording this video, year to date should be up. Brookfield is up 2%. Nothing really surprising. Brookfield is a company that is very safe, and that's my biggest position for a reason. They reported earnings, and as always, the earnings were good. It's 15% of my portfolio. The report was okay. Revenue up, earnings up, distributable earnings up. I highly recommend, if you want to know more about Brookfield, that you watch the video from Daniel Pronk. This is the best coverage I have found on YouTube. Go to Daniel Pronk on YouTube, watch his videos, great content. And literally, that's business as usual. You can go to the slides, look at all the growth, all the metrics. Everything is going in a nice direction, nice way, and actually they increased their guidance. For Brookfield, this is a big conglomerate, a big royalties company to some extent, and inside each branch, they own wealth solutions, they own real estate, they own an asset management business, and their asset management business is called BAM. It's also publicly listed. They have a stock. They increased their guidance recently. For the past 5 years, before they expected 15% per year of growth, now they are guiding for 20% growth rate. So the guidance for one of their segments is increasing. Everything is nicely done. And out of all these private equity players, Brookfield is a little bit different. You can look at the competition of all the private equity players, alternative asset managers. They are down. Apollo is down. You can see here on the year-to-date performance. We are down like 15%. KKR is down minus 15%. Because they are linked with the software sell-off. If software companies are going down, these companies are going down too. because they cover their debt. I mean, they have partnerships with software companies. Anyway, this is not the goal of today's video. Brookfield, as you have seen before, is not down. So what is happening? Well, Brookfield is linked with real life assets, long duration assets, infrastructure plays, okay, energy plays. You have less links with the software companies. So if software companies are down, people that are more or less related to these software companies will be down. Brookfield is not in this situation. I mean, the ultimate case is a blue Owl Capital here, that is, out of all the companies, more exposed to this software sell-off. So you can spot some differences in the same industry, and so far so good for Brookfield. Out of all the companies in the industry, Brookfield is the best, and it's exactly why I chose to invest in Brookfield. Out of all the players in the industry, Brookfield is the most resilient one. Out of all the players in the industry, Brookfield is increasing their guidance. Brookfield has, in my opinion, the best management team. I want to invest in the best companies, and the valuation is quite reasonable. Actually, we just learned recently that Brookfield would stop the liquidity for retail investors, halts redemptions from his private debt fund dedicated to individuals. Some potentially bad news for these investors, but Brookfield is not affected. Something to monitor in the future, but not affected. The report was okay, so life is good. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second largest position I have in my portfolio is MSCI. MSCI reported earnings. The stock went up. The stock went up 5%, and I covered this earnings report on my channel. I covered the earnings report saying the report was okay, but nothing extraordinary. So I am not touching my position, and I'm not buying more. I covered the stock on my channel. Where is it? MSCI here. Everything you need to know about MSCI's report. The earnings report, the call, the transcript, and my own Google Sheet. I am showing you all the calculation, all the formulas, so you can make an informed decision whether you want to buy or not MSCI. The video is 2 hours long, so take a cup of coffee, take a cup of tea, but this is the price you have to pay to really know what MSCI is. A short video will never have this kind of analysis. So if you want to watch this video, spend 2 hours on it and you will see what I think about MSCI. The report was okay, nothing really extraordinary. So I did not want to touch the stock. And then the stock dropped because of AI, because of Anthropic, because of Gartner, because of the guidance from S&P Global. The stock dropped and I bought the dip at $513. Turns out it was the absolute bottom. Turns out the CEO was buying at the same moment. He bought at $520. And Moody's recently reported earnings. The stock is rebounding. Fair enough. If I had to summarize this earnings report, I would say the business is safe from AI. The business is in a good shape. The business is resilient. But for the moment, we don't see the benefits of AI. They say business will reaccelerate because of AI. I'm not seeing a lot of signs. I'm seeing some cost efficiency. I'm seeing that they are doing massive buybacks. The CEO is buying, so they are really confident. The moat is intact. The growth rate is intact. The business is not dying, but at the same time, the business is not reaccelerating. What I will monitor for 2026 is the revenue reaccelerating? Because now they say AI will be a help for us. It will reaccelerate the revenue. Okay, show us. So I would love to see a reacceleration of revenue and better margins in 2026. This is something I will monitor for the future. I'm quite happy with the report. It was okay, business as usual. The stock is down, fair enough. I can buy the dip. The stock was cheap. Third largest position in my portfolio, that's Google. 11% of the portfolio. I recently trimmed Google. It was up to 16% of my portfolio, and it became my largest position. And I don't want it to be my largest position. I think you have too much risk with too much capex, and the stock is not cheap anymore. The stock is a little bit expensive to my taste, so I want to trim. The report was okay. You can check what the Google stock price is. You have a lot of euphoria for Google right now, by the way. A lot of euphoria. People become a little bit crazy when it comes to Google. When the stock was trading at 300, they say, to the moon, 400 now. And the stock went up and up and up at 330, 340, and I trimmed at this time. And people did not understand this. Fair enough. Some people invest for the short term, some people invest for the long term. I don't think the risk reward opportunity is good right now for Google, so I want to trim more. And the report was nothing sensational. They increased their capex guidance. They are growing again. They are safe, they are sound, and Google Cloud reaccelerating. That was the big shock for the market. If you look at the different segments of the market, well, look at the price to free cash flow. Yeah, the price to free cash flow is not the best valuation model for Google because there is no free cash flow. I want to show you the KPIs. I want to show the growth rate of Google Cloud. Look at this. This is wonderful on a quarterly basis. Google Cloud is growing so much. Google Cloud is reaccelerating and growing 47%. This is lovely. So you clearly have an improvement of the business because of the high capex. So most people stop their analysis here. They say, okay, Google is spending a lot of capex, but as you can see, the business is reaccelerating. Look at Google Cloud, up 48%. And most people stop the analysis here. The next question to ask, and what people are missing is this worth it? Is the growth acceleration offsetting the growth in capex? And to this, nobody has the answer. And I'm taking the camp of it's not really worth it. We don't know. And the capex is expected to continue to be immense. So I'm taking the camp of the free cash flow will be minimal for the next few years. So I'm taking the camp of I'm not sure about the free cash flow in the future. So I want to trim the position and allocate my funds and all my gains, because Google is a home run for me, to invest in other businesses when you have more visibility. This is the reason why I trimmed Google. All this capex, I'm not sure. All this free cash flow that is getting evaporated, I'm not sure. The business is now taking on more debt, I'm not sure. And for all these reasons, I prefer other companies. It's not because Google is bad, it's a bad business. It's all a matter of risk reward. And not all, but many super investors share the same view. You can see the 13F, the latest documents from super investors. A lot of them are selling Google a little bit, trimming Google a little bit because of this. Because the valuation is now expensive and we are not sure of the visibility. You can check what the super investor Chris Hone has recently said about Google. He said out of all the investments in his concentrated portfolio, Google is the most risky one. Okay? And the valuation is not cheap. It's maybe fairly valued, maybe a little bit expensive. I'm aware you have some adjustments to make, but just to show you I can show you actually I can take my time in this video. I can show you the P/E ratio without the investment gains, a metric that was created by Arya, a great YouTuber, on an annual basis. So yeah, credits to him. Credits to Arya for creating this metric, and I just copied the metric because it works. And you can see here you have a gap between the orange line and the blue line, the P/E ratio in blue, and the P/E ratio if you adjust the investment gains in orange. Because Google is called Alphabet after all, so you have to make bets to generate alpha, and it is working, which means Google is investing in other companies, they are making bets, and they have gains. And these gains are increasing the net income. But This is cheating a little bit. This is fake a little bit. I don't want to invest in Google for their other bets. I want to invest in Google, and I want to value Google for their core business model. So I don't want to take into account the other bets. So I'm removing the other bets. And what is the valuation of Google if you remove the other bets? Anthropic or SpaceX. You have a P/E ratio of 40, and I sold at this moment. I trimmed, and now the stock has dropped a little bit, but you still have a P/E ratio of 36. I can invest in other companies that are as good, growing as well, but a cheaper valuation. So this is the reason why I want to trim Google. I'm not a fan at all of the risk reward right now. So far the stock is holding up so well. You have a lot of enthusiasm, but I'm happy I've trimmed and I will continue to trim. Next one on the list, 10.5% of the portfolio. This is Mastercard. Mastercard, I'm a happy buyer. The stock has dropped for many reasons, because of tweets, because of what the president is saying in the US, because of new laws that will be passed, because of uncertainties, because Europe wants to do their alternatives to Visa and Mastercard, because India is doing a payment alternative, because Brazil is doing a payment alternative, and people freak out because this is a clear uncertainty. I'm buying the dip heavily, actually. And if Mastercard drops more, I will buy more. They recently had an earnings report that was perfect. Despite Europe and their new regulation, despite Brazil and India and their new regulation, they are growing massively. And their plans to disrupt Visa and Mastercard, European plans, will take into effect in future years. So I think the runway for Mastercard is pretty good. And I covered Mastercard on my channel. Here we go. Mastercard just reported 10 out of 10 earnings, plus full call analysis. A 1 hour long video. I did the reporting for you. So if in case you want to know more about Mastercard and the latest earnings report, 10 out of 10. Wonderful. And it's a 1 hour video to do the work. It's a lot of conviction, and I'm a happy buyer, and I want to buy more as it drops. Also in this video, like today, right now, I will show you this. I will show you the metric of my overall portfolio at the end, because it has increased. Okay. Next one on the list, you have Fortinet. Fortinet. I'm so happy with Fortinet, actually. They say don't fall in love with your stocks, but you know me. I mean, I post every day on YouTube. I think you can sense that. There is no editing in my videos, so I just love it. I just love the game. I do this all day long. I help my clients do the same to improve their performance. I just love the game. And sometimes I know I don't have to fall in love with stocks. But when I see crazy opportunities, I can like a stock. Not love a stock, but like a stock. Fortinet is a company in this situation. The company is wonderful. The management team is wonderful. The insider ownership is wonderful. The sector, the cybersecurity industry, is wonderful. Recession-proof, growing at least 10% per year. The margins, wonderful. The capital allocation decisions, buybacks, wonderful. They don't pay a dividend because it's not tax efficient, like Warren Buffett. They do buybacks only when the stock is cheap, like Warren Buffett. They are not doing stupid acquisitions and dilute shareholders, like Warren Buffett. This is a wonderful capital allocation decision framework. This is a wonderful management team, a wonderful industry, wonderful margins, and a wonderful stock price. If you had bought Fortinet, you would have outperformed the market. Like if you had bought at the IPO, you would have made like 30% per year. You can just buy Fortinet and go to the beach and sleep. And that's it. The cybersecurity industry will lift your results. You will lift all boats, actually. And I first bought Fortinet in 2020 because I saw the new wave of innovation and COVID, saying it will reaccelerate the digital world. So I want to be invested in cybersecurity. Guess what? Everything accelerated, Fortinet made a fortune, and I made a fortune. The stock went up and up and up. And then it went expensive. It became expensive, so I did not buy more, and I sold, actually. I took my gains and invested in other things. 2020, 2021, 2022, 2023, 2024, 2025, 2026, 2027, 2028, 2029, 2030, 2031, 2032, 2033, 2034, 2035, 2036, 2037, 2038, 2039, 2040, 2041, 2042, 2043, 2044, 2045, 2046, 2047, 2048, 2049, 2050, 2051, 2052, 2053, 2054, 2055, 2056, 2057, 2058, 2059, 2060, 2061, 2062, 2063, 2064, 2065, 2066, 2067, 2068, 2069, 2070, 2071, 2072, 2073, 2074, 2075, 2076, 2077, 2078, 2079, 2080, 2081, 2082, 2083, 2084, 2085, 2086, 2087, 2088, 2089, 2090, 2091, 2092, 2093, 2094, 2095, 2096, 2097, 2098, 2099, 2000, 2001, 2002, 2003, 2004, 2005, 2006, 2007, 2008, 2009, 2010, 2011, And now the stock has done nothing, and the stock dropped to a more reasonable level in August 2025. I bought in August 2025. We went back to being fairly valued. And I can go to Stock Unlock Scores, which is a new segment in this wonderful website. And you can see this. The stock was red, which means expensive. And it dropped so much it became orange, which means fair value. I bought the dip. And then it went down again. I bought the dip again. And it went to green, so crazy cheap. And then went up again. Nothing has changed here. I'm a happy buyer of Fortinet right now. I published a video on my channel about Fortinet's latest earnings report, a 2 hours long video. Everything you need to know about Fortinet's earnings, the call, the Google Sheet, the adjustments, everything you need to know. I'm such a believer in Fortinet. I would gladly make it my first position in my portfolio. But I am greedy, so I don't want to pay up. And after the earnings report, the stock went up to $88, and I don't want to buy at $88. So I want to buy at a low price. I'm a cheerleader for the stock price to go down, actually. Because I want to buy more, and I want them to continue to do buybacks. They are doing buybacks massively right now. Even in 2026, they already started a massive buyback program. So I want the stock price to not go up. I want the stock price to stay low. That's fine. I will underperform in the market in the short term. That's fine. But it will massively increase my free cash flow per share in the future. This is the mindset you need as a long-term investor. Short-term pain, long-term gains. It's okay to underperform the market if you know what you own. If you know that the companies you invest in are taking advantage of the volatility. The stock is down, they do massive buybacks. So the earnings per share are going up. So in the long term, you will make 20% per year. This is the key mindset shift some people lack. They just want the stocks to go up and up and up and up. They want to do buybacks. I think this is not the best way of generating long-term wealth in stocks. You want a sound, profitable, long-term wealth generation. And Fortinet is doing this perfectly. So I'm a very happy buyer of Fortinet, not at current prices. I will be greedy because that's already 10% of my portfolio. But if it drops below 80, you will see. You will see. The stock is, the risk reward is incredible right now. Am I done with Fortinet? This is this. By the way, you see me on Stock Unlock. You see me on Fiscal AI. I have discount codes in my description. You can try Stock Unlock with a discount, and you can try Fiscal AI for free. Click the link in my description. Click and try it out. 2 weeks, completely for free. And then you will have a discount after this. So literally zero risk to try it out. Use my link. No credit card, nothing. Just put your email and try it out completely for free for 2 weeks. You will love it. These are the best websites I have found when you talk about investing. This is love, and this is so worth it. The time you waste, but you don't know you waste, is unbelievable. And the time you save by using these tools is incredible. There is no going back. But you don't know when you don't know. You don't know what you don't know. So try it out. Try it out for 2 weeks for free. And then come back to me and say you love it. Okay, next one on the list, you have Meta Platforms. I reported a video about Meta plus 10%. It went up 10% actually. Meta earnings were good, but I'm not buying more. And basically, the report was pretty simple. The fourth quarter of 2025 was exactly the same as the third quarter of 2025. But in the third quarter, the stock went down 10%. And for the fourth quarter, the stock went up 10%. This is exactly the same report. You can see me, I made a video back in the days, 3 months ago, 4 months ago, and the arguments are exactly the same. The business is increasing their capex spending, and it is bearing fruits. So the business is reaccelerating the revenue. They are seeing more ads, more ad impressions, more ad pricing, better ad targeting. It is working. And for some reason, the stock went down in the Q3. And for some reason, the stock went up in Q4. Out of the Magnificent 7, I have to tell you, Meta Platforms is my favorite one. in terms of risk, reward. The stock is rather cheap right now, and I love it. I love it. What is the forward? I will not use the PE ratio because they have one-off tax to pay. I mean, they have paid special taxes for the PE. I'm not sure it is taking into account this. Anyway, let me check. Forward PE ratio for the stock. This is what we have, roughly speaking. They had to pay an extraordinary tax. Anyway, you have a business. Forward PE ratio of 21. This is the risk reward is very good actually for this one. This is why I said I'm not a fan of Google and their capex, and I'm not a fan of Meta platforms and this capex. But I would rather buy Meta than Google. Out of the two, I prefer Meta platforms because I believe more in Meta platforms actually. You have revenue reacceleration. They guided for 30% growth rate in revenue. And now you have a forward PE ratio of 21. Seems decent. Fortinet is better. MSCI is better when it comes to the risk reward. I prefer other opportunities. But this is the reason why I am holding Meta platforms. I will not buy the dip. I will not sell for the moment. Maybe I will trim in the future, but for the moment I will hold. Out of the two, I will trim Google first. The report was okay, and the stock price went nowhere actually. It went up and then down. Really, if you've been on the sidelines for a while, I could totally understand people buying Meta platforms now. The stock is cheap if you look at the PE ratio. Stock is cheap. But take into account the risks, right? The capex, etc., and your opportunity cost. Do you really want to buy Meta platforms when you can buy other software companies that are down a lot? It's all about the risks. If you know what you're doing. If you don't know what you're doing, don't invest. If you know, buy an S&P 500, buy an ETF, an index, MSCI World, and go to sleep. If you know what you're doing, you can do your own stock picking. And this is my job now, and I'm making 25% per year. So it seems like this risk reward thing is working. Next one on the list, you have Adobe. Oh boy. Adobe gave me a lot of comments on YouTube. People love Adobe or people hate Adobe, but you are not indifferent when somebody talks about Adobe. It's very crazy. The sentiment for Adobe is crazy. Either people love you when you talk about Adobe, or people want to kill you when you speak about when you talk about Adobe and you say you are bullish. Guys, these are stocks. This will not change your life. People are so in love with their stocks, it's kind of crazy. Or they just hate a lot their stocks and they want to kill you and they say you are stupid. Yeah, that's fine. You have a little bit of everything. Invest in falling knives if you want. Invest in value plays if you want. Invest in dividend plays. But don't hate somebody else just because they are bullish on the stock. You have better things to do with your life. Why hate? I'm not understanding it at all, actually. Why people are getting so mean on the internet. This is the new generation, the new era of getting mean. But anyway, let's talk about Adobe. The report is not there there yet. Sorry. March 12th. I will make sure to comment on the situation. But we can cross-read things between Adobe and different software companies. ServiceNow is a good example, or Fiverr is a good example, Upwork. We can already spot patterns, companies that are winning and companies that are losing. All the companies that are losing, Wix.com, Fiverr, Upwork, clients down, active accounts down, monetization down, the stocks are getting killed. And for other companies, Atlassian, ServiceNow, IT, things are pretty good. Nothing really changing. They are starting to monetize AI. The growth rate is good. And for ServiceNow, the CEO is buying the dip. Extremely confident. And some CEOs of software companies say that people are getting delusional. They don't believe in us. For a lot of software companies, the valuations were high. ServiceNow is a good example. ServiceNow is a company that is loved by many retail investors, because the retention rate is nice, the CEO is charismatic, the fundamentals are good. And if you look at the forward PE ratio, it's at 25. So some people may argue, yeah, it's fairly valued, wonderful business, fair price. Okay, but you started the valuation with the forward PE ratio of 60 or even 50. So the starting point was high. And the drawdown is significant because you start from a very high point. Now, I know what people say online. They say ServiceNow has the largest drawdown ever, minus 50%. Of course, I mean, if you start from a very high plateau of valuation, you will drop a lot and still you are not cheap. Now let's talk about Adobe. You will understand why I bought Adobe. You didn't start from a very high plateau of valuation. You have one of the largest drawdowns in the stock, minus 60%, but the starting point of the valuation was not high. The starting point of the valuation was a forward PE ratio of 30, and the stock has gotten so much hate. The stock is down so much that now we have a forward PE ratio of 11. I can use PE ratio, can use the price to free cash flow, anything works actually. I know some people like PE ratio, some other people price to free cash flow. I would prefer to have the free cash flow actually, always. Forward price to free cash flow of 10. We are getting to a stupid cheap valuation for Adobe. If Adobe survives, maybe they can fail, okay? This is also why I'm not putting 40% of my portfolio into Adobe. The stock is down, the stock is cheap, they are doing massive buybacks. They say we are fine. They say publicly, you guys are wrong, we are fine, we will thrive. But what if they are wrong? What if they tell lies? What if they fail? It's all about portfolio allocation, right? So I created a 10% position for Adobe and I'm down 20%. So it is only an 8% position. That's fine. It will not kill me. I can lose 50% of the position. It will only impact 5% of my net worth. That's fine. But if I'm right, I make 20% per year. This is the risk reward I like to see. And this is the reason why I am not down minus 10% year to date. I am flat, like literally zero, like the index, because it's about risk allocation, portfolio construction, arbitrage. I don't want my portfolio to be crushed. I don't want my portfolio to have a lot of volatility. And this is the reason I have outperformed the market. In good times, when the stock market is up, I'm up more than the market. And in bad times, I'm down less than the market. In 2022, when everybody was down 20%, I was only down 5%. So the rebound in 2023 was much faster for me, okay? So I can compound more rapidly. And a good way to do this is to not go big on falling knives like Adobe. The stock is so cheap right now. I'm looking forward to March 12th actually, because I don't think the market will believe them. I think the stock will continue to go down for a while. If I had to make a guess, right? Nobody knows. Maybe I'm releasing the video today and tomorrow you have an announcement they are laying off 10% of employees and the stock skyrockets. Nobody knows. You don't know, I don't know. Nobody knows. But it took a couple of quarters for Google to rebound in valuation. We had the same hate for Google a couple of quarters ago, a couple of months ago in 2025. And they delivered good returns. People did not believe them. They say, no, you are growing Google search by 11% per year. We will not believe you. And the stock fell off. Next quarter, the revenue was okay for Google. The business was okay. Wall Street did not believe them. No, I don't believe you. Again. And it took a couple of quarters of consistent growth to finally change the mindset, the sentiment. And I believe the same thing will be true for Adobe. This is why I am buying the dip. I think the stock is cheap, they are doing buybacks and the business is safe, but Wall Street is not sharing my enthusiasm. Wall Street is not sharing my bullishness for Adobe. This is fine. I'm gladly taking a contrarian bet. I am seeing all the videos on YouTube saying Adobe will get displaced, disrupted. And I'm seeing also all the videos saying Adobe is fine, you cannot hurt the ecosystem. Do your bet and wait. That's it. There is no point in arguing anymore. People know the arguments. Either you are bullish or you are bearish, or you don't touch the stock. That's it. This is why I'm not making a lot of content on Adobe. We already know everything. Choose your side, choose your camp, and wait 3 years. See if they implement AI or not. And we'll see. Maybe I will be completely wrong, and that's fine. Or maybe I will make 20% per year, and that's fine. Okay? So looking forward to seeing the results. I'm not expecting anything actually. I'm expecting the same speech. The management team will say, we are fine, and the stock will not do anything. The Adobe bet is not a bet for 2026. I am buying Adobe for future years. If the stock goes down for 2026, I think I will not buy more for this one. It's already a big position, but I don't have such a big conviction that I want to make it huge. For MSCI and Fortinet, I have huge convictions, so I can buy the dip if it drops. For Adobe, no. But we will see. On the list, next you have Lam Research. Lam Research is unstoppable. The hardware versus software dilemma is great. Lam Research I bought at $80 in late 2024 and beginning of 2025, and now it's $200. And this is why I generated a huge performance in 2025, and I outperformed the market in 2025 because I was invested in Lam Research, and I held and I held and I held and I held, and it was a huge part of my position, and I recently trimmed. But all the alpha I had in 2025 was by Google, thanks to Google, and thanks to Lam Research. Home runs, made a fortune out of this one. And if you look at the valuation, we are extremely expensive right now. Compared to history, compared to the industry, compared to the growth rate, this is the forward price to free cash flow of Lam Research. Look at this chart and tell me it's cheap. Who can look at me in my eyes and tell me Lam Research is a good value to buy now? I am happy to sell my shares right now. I'm a happy seller. I already sold a little bit on the way up at a forward price to free cash flow of 45, and it is getting higher and higher. The forward PE ratio is at 40. Regardless of any metric you look at, any growth rate, the stock is expensive right now. So yes, I like the stock. Yes, I like the company. I think the management is exemplary. The capital allocation decisions are great. Great margins, great efficiency, great moat. But the stock has gone up so much, it's all about risk reward. And as a retail portfolio manager, I mean, I'm managing money for more than 360 people on eToro. I have the responsibility of making smart decisions. I am responsible for their wealth because they are copying my portfolio. So I'm taking a decision to trim, and I will continue to trim as we go into 2026. Now you have a great momentum for hardware companies. I will be very happy to sell. That's fine. That's not my game. I'm not a momentum trader, guys. I invest in deep value. I invest in great quality companies when they are at a fair price, which was the case when I bought. And the stock tripled. I mean, 80. Yeah, the stock tripled, and I'm out. I want out. The valuation is extremely, extremely expensive right now. People are delusional. They think there will no longer be cyclicality in the hardware industry. The report was fantastic. The guidance was great. The earnings was great. But come on, the price was just too high. So I want to sell. On the list, next you have Landbridge. Landbridge is a speculative play. Landbridge is misunderstood. So it's a speculative position in my portfolio. Landbridge is only 5 or 6% of my portfolio. It is moving a lot. And it is not for everybody. So I would not encourage you to follow me on this trade at all. If you don't have the stomach. It goes up a lot, down a lot. Up a lot, down a lot. And now up a lot. It is not for everybody at all. I don't encourage anybody following me. The next earnings report is February 25. Maybe I will cover it on my channel if there are some good things to say. If there are no changes, I will not cover it. So we will see. It's a buy and hold for the long term. It's a speculative play. If I'm wrong, I lose everything. I lose like 5-6% of my portfolio. If I'm right, this is a golden opportunity for the next 20 years because it's about having lands in the Permian Basin in Texas and doing everything to welcome data centers, to process their water, have the energy, the gas turbines, and the data centers in Texas, in the Permian Basin. And they are working very hard, growing very well to be a welcoming ground for data centers. You have a lot of supply chain issues, bottlenecks when it comes to energy and water, and their location of lands is very good for welcoming data centers. So maybe out of these different AI bottlenecks, Landbridge will benefit a lot. When I say a lot, I say it will be huge. If they are right, it will be incredible. But again, that's a big if. Maybe they will completely fail. And this is why it's only 6% of my portfolio right now, right? It's all about portfolio optimization, monitoring your risk. You don't want to have your biggest position Landbridge. I mean, I don't know if anyone can survive the volatility. And then we go into smaller positions. AutoZone that I am selling to buy more MSCI, by the way. AutoZone is a good company. I don't think they reported earnings. Already reported earnings, which were fine. Business as usual. AutoZone is reporting earnings on March 3rd. The results will be fine. We already know the results in advance. Nothing will shock the world. And I want to move away from AutoZone, not because it's a bad business model. It's because I can find better risk-reward opportunities. Fortinet and MSCI. Very simple. So I'm a happy seller, not because it's bad, just because I have found better. Then you have FICO, Fair Isaac, the latest addition for my portfolio, a company that is definitely not cheap, but the company is very well run. And I covered the stock here. You have a 30-minute discussion here. You have, what is that, FICO? I have analyzed the FICO actually. Oh no, it's on a live. I did a live session with the members of this YouTube channel about the earnings report. So if you want to see the analysis and if you want to attend the other lives, Q&A most of the time, you can ask me questions directly live. You can become a member to this YouTube channel. You have two tiers. Either you join, I think, for $5 per month to have access to the live sessions and you will get more support, or you become a prestige member of this channel. It's $25, but you have exclusive videos that are not for other people. You have videos in advance, and you have the priority when it comes to your questions and your comments. If you want the priority of your comments, or just if you want to support the channel, you can become a member, and you can have access to this video. Anyway, I bought the dip. This is public. This is not for members. I bought the dip of Fair Isaac, and we will see. The report was really good. The guidance is too low, the management is conservative, and the business will reaccelerate. If the stock goes down, I will buy more. If the stock goes up, I will hold and not buy more. I want the stock to go down. I want the stock to go down. The report was okay. I want the stock to go down a lot actually. I want FICO to be a huge position in my portfolio. And now at current prices, it's not cheap enough for me. It's maybe fair value. A tiny bit expensive, fair value. So I want the stock to drop. I mean, drop a lot. Drop 30%, drop 50%, please. I would love this. A huge recession, so Fair Isaac goes down. The interest rates in the US go up for some reasons, so FICO gets crushed. Mortgage origination. I would love for the stock to go down. Short-term pain, long-term gain, as always. And the last one on the list is AMR, a coal miner that nobody cares about. It's the only value investing play I have in my portfolio for the simple reason that it's extremely cheap and nobody wants to cover it. If you look at AMR, it's a methodological coal play. After talking about AMR, I will show you the filters, all the metrics of my portfolio. it will help you, I think. If you look at AMR, you can see it's a small company. Market cap of $2 billion. Look at this, $2.5 billion. Remember this, $2.5 billion. And it's cyclical. It's hated. It's not sexy at all about coal. But look at the cash they generate. Look at the free cash flow they generate. This is good. Okay, fair enough. You can see for the past decade the free cash flow in green. Either you are slightly positive to $100 million, or in down years and downturns you are flat, or when you are positive, this is a company that can generate free cash flow of $1.3 billion in 2022, $600 million in 2023, $400 million in 2024. If this industry rebounds, AMR has the potential to generate $1 billion of free cash flow. And if the industry is in a drawdown, not looking good, we are not losing $1 billion of free cash flow. We are flat. Look at this. When the world shut down, we were slightly negative. I'm seeing this as a beautiful risk-reward opportunity. If the industry is slow, if there is no demand, you are flat. Look at this. The industry is living through a drawdown actually right now. And the free cash flow is flat. No free cash flow was generated. But boy, when you have a positive industry that is helping you, commodity prices are going up, this stock, this company has the potential to generate $1 billion of free cash flow. And the market cap is $2 billion of free cash flow. So in 2 years, you can cover all your free cash flow, all your market cap. And what is the management doing with their cash flows? They're doing massive buybacks. Every cash flows they have is used to fund a little bit of capex, but mostly buybacks. They even stopped dividends to allocate everything to do buybacks. Look at this. Diluted earnings per share, diluted number of shares. You can see that since COVID, they repurchased 18% of their shares. They really want to do as many buybacks as possible. Fun fact, there is a new... Oh, this is good. You have the exclusivity. Today, I've never talked about this before. Now I get you hooked. You have a new tab on Fiscal AI called Query. And I believe you can find a word, I don't know, like undervalued. And you can see all the companies that mentioned undervalued. For example, MSCI said our franchise is undervalued. I know this, I covered the earnings call. So if I scroll down, you have all the companies that mentioned the word undervalued. Do you have MSCI? I don't know. Filter company. Is MSCI doing it? Yes. We believe our franchise remains undervalued. This is so good. If you want to find a keyword, so good. And there is a keyword that I have only seen for AMR. It was in 2023. And this is the moment they stopped dividends to allocate all the cash to do buybacks. They said, we are criminally undervalued. It's summer of 2023, I believe. First quarter of 2023? I don't know. We are criminally undervalued, so we are doing as many buybacks as possible. And I love these situations. A little bit similar to Adobe to some extent. They are using all their cash to do buybacks. AMR is doing the same thing. So for the moment, the cycle is bottoming a little bit, but nothing really crazy. And I'm having 2% of my position, of my portfolio, for this value play. If they fail, it's okay, it's only 2% of my position. But if they succeed, and in 2 years they can generate as much free cash flow as the entire market cap, I will make a killing out of the stock. So this is why I'm still holding AMR out of all the value plays I had in the past. And I have zero cash. Now I want to show you my metrics of my portfolio. These are the metrics you can find on Fiscal AI. As always, try it out completely 2 weeks for free. I showed you the query, the charts, but also this. You can put your portfolio and they will give you the metrics of your portfolio. So at the right of the screen, you see the pie chart. Brookfield, biggest position, 15%. All the holdings, MSCI, Google, Mastercard, etc., etc., etc. And at the left, I have put this. At the left of this table, you have an average market cap. You have the ROIC, return on invested capital of my portfolio, at 25% per year. In the very long term, stock prices will follow free cash flow per share, will follow ROIC. If the ROIC, return on invested capital, is high, it means efficiency. And now it's really high for my portfolio. I am invested in really efficient companies. Now, about the revenue growth rate. For the past 10 years, my overall portfolio has grown revenue at 15% per year. Has grown operating income EBIT at 22% per year. The delta between 15 and 22, that's the margin improvement. So all my companies in overall has gotten more efficient. Then the net income is growing at 22% per year. So similar to EBIT. And the diluted EPS has grown at 24.4% per year. So for the past decade, the earnings per share of my portfolio right now for all my companies have grown at 24% per year. And I think they can continue. This is why I think I can continue to make 20% per year. Also, look at this, the capex to operating cash flow. The reason why I sold AutoZone, the reason why I sold Google, the reason why I sold Amazon. I want my portfolio to be asset light. I want my portfolio to be an inflation hedge. So I want to avoid companies that are using a lot of cost and a lot of capex. And if you look at all my companies, they have minimal capex now. FICO, MSCI, Mastercard, Adobe, almost zero capex. Landbridge, Lam Research, almost zero capex. So as time goes by, I want this ratio to be as low as possible. And when I entered 2025, it was not this low. It is the ratio between operating cash flow and capex, meaning 40% of my operating cash flows are going to capex, and the remaining 60% is for dividends, buybacks, or excess cash in the balance sheet, or acquisitions. Yeah, acquisitions, I don't like this, so I don't invest in companies that are doing acquisitions like this. But I want this ratio to get lower in the future. And it is getting biased because for Brookfield, this ratio is at 1.3. For Brookfield, you have so many adjustments to make. They are a little bit impacting this metric. So actually, the real capex to operating cash flow is lower if you make the adjustment. But just, I will not make any adjustment for the sake of this video. It's 0.4. Small dividend. Forward PE ratio of my portfolio, 26. I cannot use the forward price to free cash flow because for Meta, it's ridiculously high. And for Google, ridiculously high, like in the hundreds. For Meta and for Google, they plan to invest massively in capex. So the free cash flow is near zero, which means the price to free cash flow is plus infinity. So I cannot use a free cash flow measure for my portfolio. That is too sad. So I'm using the price to free cash flow, not even forward, just the price to operating cash flow, and I'm 22. I think that's pretty reasonable. So in my portfolio, I have exemplary, leading, winning companies at a reasonable price. What do I say by exemplary companies? Gross profit margins at 70% on overall average, operating margins of 40%, net margins of 26%, and the cash flow unlevered for the past 10 years is 16%. Again, it's getting biased a little bit because of Brookfield, but you get my point. All the metrics of the portfolio are positive. High margins, growing double digits with a lot of efficiency, the minimal capex, and the valuations are pretty reasonable. We are not cheap, but we are not crazy expensive. So I have built a portfolio of extremely well-run companies, great companies available at a fair price. And I believe this portfolio has a lot of potential in the future. So this was a big update of my portfolio and all the companies I own. Don't forget to click my link in the description to try Fiscal AI completely for free. You can try it out for 2 weeks. I'm sure you will love it, and I see you tomorrow for another video. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.